All right, well, first quarter GDP rose only 0.2%, falling short of the 1% growth economists were looking for. This comes after the economy grew 2.2% during fourth quarter. So what does this mean for stocks? Let's bring in Michael Hewson, chief market analyst at CMC Markets, with us now from London. And Michael, your reaction to the disappointing GDP, isn't it more than just cold weather?
Yeah, I think you can certainly make the case for that, Scott. I mean, you can talk about the West Coast strike. You can talk about the paring back and the rig counts because of the lower oil price. But overall, I think what we've seen here is confirmation of what I've thought's been happening in the US economy for quite some time now. Simply speaking, the 70% of GDP that encompasses the US consumer doesn't feel compelled to go out and actually spend money. And this is a trend that I've been monitoring for the last 4 or 5 months. Yes, we've been seeing very good jobs numbers, but those positive jobs numbers aren't actually translating into significant economic activity in the US economy. And you can blame the cold weather if you like, but I only think that's part, of the problem.
I mean, there seems to be a more fundamental issue with the consumer. I mean, we've seen gas prices low for 6 months now, but people are still not spending. What do you say?
I think the data supports that. If you look at durable goods, core durable goods, they've declined 6 months in a row. If you look at retail sales, they've missed expectations for the last 4 months, undershooting expectations. And if you also look at the recent jobs numbers, 126,000 in March, if you actually look at the ADP numbers, they've actually been declining since November. Yes, they've been growing jobs, but they've been growing jobs at a much slower rate month on month. And I think, we can talk about the Fed meeting later today, but I think next week is going to be particularly key in the context of what the Fed does next, because if we get a poor payrolls number next month, then I think we could rule out any rate hike this year.
Yeah, what do you think the Fed's going to do later today? I mean, they released their statement at 2 p.m. I mean, it's hard to believe that a June rate hike or even a September rate hike is in play.
I don't think so, and I certainly think the bond markets are reflecting that. They're pushing out their expectations for a Fed rate hike this year already. Some people are talking about October and December. I think there are concerns amongst some policymakers within the Fed that the softening of data is a little bit more than transitory. Certainly, I think Mr. Lockhart has articulated that in recent days. And I think for me, it would be very, very risky for them to even consider pushing rates up. As to what could come out of tonight's Fed statement, I think it's going to be deliberately ambiguous. I think it's going to be data dependent. And I'm not sure it's really going to tell us anything we don't already know.
Yeah, and just real quick, what does the weak economic data mean for stocks?
Well, I think that's one of the big imponderables, if you like. We've been trading pretty much sideways for the past 4 or 5 months. Yes, we made a marginal new high on the S&P 500 earlier this week, and obviously the Nasdaq Composite made a fresh all-time high. But predominantly, we're not really breaking aggressively higher to the top side, and that suggests to me we're going to continue to range trade with support around about the 2075 level on the S&P, and that's likely to be the case for some time to come, because the dollar, I think, is going to continue to remain strong. And let's not forget, compared to last year, the US dollar is still 20% stronger than it was last year.
All right, Michael Hewson, thanks so much for joining us from London.
Thank you.
I'm Scott Gamm, and you're watching The Street.